Yeah, good evening, guys. My name is Larry B, and this is the second video regarding chart patterns. This is the technical analysis class, and the topic I'll be taking this time is chart patterns. It is a continuation of the previous class. And in the previous class, I talked about the 10 best chart patterns that I believe you should understand and have a perfect knowledge of as a technical analyst and a trader. And they are: number one, head and shoulders pattern; number two, double top pattern; number three, double bottom; number four, rounding bottom; number five, cup and handle; number six, wedges; number seven, pennant or flags; number eight, ascending triangle; number nine, descending triangle; and number 10, the symmetrical triangle. Now, there is no one best chart patterns, because they are all used to highlight different trends in a huge variety of markets. So oftentimes, chart patterns are used in candlestick trading, which makes it slightly easier to see the previous open and closes of the market. Some patterns are more suited to a volatile market, while others are less so. Some patterns are best used in a bullish market, while others are best used when a market is bearish. So that being said, it is important to know that the best chart pattern for your particular market, as using the wrong one or not knowing which one to use, may cause you to miss out on an opportunity to make profit. So before getting into the intricacies of different chart patterns, it is important that I explain the support and resistance level, which I already did earlier. Support refers to the level at which price stops falling and bounces back up. I explained in the previous video. While resistance is where price usually stops rising and dips back down. So the reasons why the level of support and resistance appear is because of the balance between buyers and sellers. Any trade, any chart at all, any market at all, it all boils down to support and resistance. Once you understand support and resistance to a significant extent, and you can identify it clearly in any chart, you're already one step away from making profit. Once you're able to identify your support and resistance, whether you're using trend lines or you're using the horizontal lines, once you're able to identify it just by looking at the chart or doing one or two things, you are already on your way to making profit. So the reason these levels of support and resistance appear is because of the balance between buyers and sellers, or demand and supply, like I said before. So when there are more buyers than sellers in a market, or more demand than supplies, price tends to rise. And when there are more sellers than buyers, that is, there is more supply than demand, the price usually falls. It is very simple and straightforward. So for an example now, let's say a crypto's price might be rising because demand is rising and outstripping supply. But the price will eventually reach the maximum that buyers are willing to pay, and demand will decrease at that price level. And at this point, buyers might decide to close their position. So this will create resistance, and the price will start to fall towards a level of support as supply begins to outstrip demand, as more and more buyers close their position. So once an asset price falls enough, buyers might buy back into the market. They will see it as an opportunity to enter the market again, which will also create another level of support where supply and demand begin to equal out. So if the increased buying continues, it will drive the price back up towards a level of resistance as demand begins to increase relative to supply. So once a price breaks through a level of resistance, it may become a level of support. They will flip side. So type of chart pattern, like I said before, we have the continuation pattern, we have the reversal pattern, but one I didn't talk about is the bilateral chart pattern. So a continuation pattern signals that an ongoing trend will continue. A reversal chart pattern indicates that a trend may be about to change direction, but a bilateral chart pattern will let the trader know that the price could move either way. Bilateral chart patterns are ranging trade. You will see that you don't know where the market is going. It's just one-sided. It's just one-sided. Those are bilateral trades. Bilateral trades are one-sided. For example, now any pattern that it is giving you here, you won't even know where the market is going because it is consolidating. That's a bilateral pattern. So the price could move either way, and market is very volatile at that point. So for all of this pattern, you can take any position, whether short or long, depending on whatever chart pattern you are seeing and the trend. It depends on the trend. So the most important thing is to remember that when using chart patterns as part of your technical analysis, they are not a guarantee that a market will move in that predicted direction. Nobody father own the market. I've been repeating this since. Do not be too sure of where the price of a coin is going. That is why there are stop losses to guide you. So always set stop loss in every of your trade, no matter how sure you are of the direction of the trade. Stop loss will save you from unnecessary stress. Stop loss will save you from unnecessary stress and losses. So now back to the chart pattern. The first one is the head and shoulder pattern. Now, head and shoulder pattern is a chart pattern in which a large peak, I'll show you the head and shoulder pattern. This is the head and shoulder pattern. This is the head and shoulder pattern. So head and shoulder pattern is a chart pattern in which a large peak has a slightly smaller peak on either side. Traders look at head and shoulders pattern to predict a bullish to bearish reversal. Whenever you see this thing, the trend is most likely to change to the downside. So typically the first and third peak will be smaller than the second, but they will all fall back to the same level of support. As you can see this line, they will fall back to the same level of support. And it is likely to break out into a bearish downtrend. That is what always happens whenever you see an head and shoulder pattern on your trade. Once you see it that it's already forming head and shoulder, just know that the trend is most likely to change and the support is more likely not to hold. The support is most likely not to hold whenever you see something like this. Then the next one is the double top pattern. This is the double top pattern. So a double top is another pattern that traders use to highlight trend reversals. Typically, an asset price will experience a peak before retracing back to a level of support. It will then climb up once more before reversing back more permanently against the trend. It is also bearish. Double top is also a bearish chart pattern. It is bearish. So once you see something like this on your chart, once you see that it's already forming, that this first one has already touched and it went back up again and it's coming back down, just know that at this point, it is most likely not to hold. And once this one closes below this support, it is definitely going on a downtrend. So it is advisable that once you see something like this, you know that at the close of this candle, you enter the trade and you set your stop loss above the previous week. So your stop loss will most likely be around this place. Your stop loss will be around this place, and you TP anywhere. But make sure you are taking profit at the right place also on your chart. Then the next one is the double bottom. Double bottom. So this is the double bottom. Look at how it's the opposite of the double top. Now you have this at the bottom. Double bottom chart pattern basically indicates a period of selling, causing the crypto's price to drop below a level of support. It will then rise to a level of resistance before dropping again. Finally, the trend will reverse and begin an upward motion as the market becomes more bullish. So a double bottom is a bullish reversal pattern because it signifies the end of a downtrend and a shift towards an uptrend. So whenever you see a double bottom, you see a double bottom like this on your chart. Then you see a zone here like a resistance. You see a zone like a resistance here. So once the price goes above that resistance, just know that the bulls are inside the market already and they are most likely. So in a point like this, you wait for this candle to close. Once it closes above this neckline, the resistance, once it closes above the resistance, you enter the trade, most likely at this point. Then your stop loss will be here, the previous week, or slightly below this one. So as you can see, if your stop loss is here, you won't hit stop loss, and when this candle came back below the neckline briefly, it was just a fake takeout to take out some people's stop losses and continue in the upward direction. So it is part of trading psychology. Always understand your entry and exit. So you wait for it to close. So it closed there. So you enter the trade at this point. You enter the trade at this point, then your stop loss will be below the previous candle, below the wick of the previous candle. That way your stop loss will most likely not hit and your trade will go in profit. That is double bottom. Then the next one is the rounding bottom. This is the rounding bottom. Like it does not really have a particular shape, it just goes like that. So a rounding bottom chart pattern can signify a continuation or a reversal. For instance, during an uptrend, the coin's price may fall back slightly before rising once more rather. Oh God, I'm tired. So it rises forward to this point. So it comes down and just starts ranging in a round form. Something like this. It just comes down and starts ranging in a round form. Then it continues the movement upward. That is just the round. So it is a bullish reversal pattern. So traders will seek to capitalize on this pattern by buying halfway around the bottom. So if you are entering this kind of trade, you should be entering around here. As you can see, this is my cursor. So your entry should be around this half of the rounding bottom. Then your stop loss will be below the wick. Will be below the rounding bottom. It will be below the wick here. So that way it will most likely not hit your stop loss and head to the other direction. And it usually does not come back on time. This type of chart pattern is very rare. You don't really see it every time. And once you see it on your chart, just know that the trend has changed to the other side and it does not really come back towards that place on time. So if you miss it, just look out for another pattern or another entry before you enter such trade. Then the next one is the cup and handle. The next one is the cup and handle. The cup and handle is also similar to the rounding bottom, but the difference is that it encompasses another chart pattern. So the cup and handle pattern is a bullish continuation pattern that is used to show a period of bearish market sentiment before the overall trend finally continues in a bullish motion. So the cup appears similar to the rounding bottom chart pattern, and the handle is similar to the wedge pattern. It's just like a combination of the two. The cup and handle is like a combination of the wedge and the rounding bottom. But following the rounding bottom, the price of an asset will most likely enter a temporary retracement. So when you see such retracement, it is called the handle. So while the market was entering this rounding bottom or cup, when it got to a certain stage, it reversed back to form a wedge in between. So this wedge will just signify is like an handle, which signifies that the bullish trend is most likely to continue. So once you break this line, once you close above this line again, you enter the trade and you ride your profit and you set your stop loss below the wick. As always, that is the best way to safeguard your capital. Always set stop loss. Always set your stop loss. So once you do this, you are most likely to have a profitable trade if you see something like this and you enter with the rule. Enter at the close of it, set your stop loss below the wick, and ride your profit. And make sure you close your trade on profit on time also. Then the next one is the wedge. We have two different wedges. We have the rising wedge and we have the falling wedge. So the first one is the rising wedge. So wedges form a coin price movement that tighten between two sloping trend lines, and there are two types of wedge, rising and falling. It is similar to the channel that we talked about in the previous class. Wedges is similar to the channel, but it is not straight like channel. Channel is straightforward, like parallel, almost the same size, but wedges is different. So a rising wedge is represented by a trend line cut between two upward slanted lines. I laid emphasis on slanted lines of support and resistance. They are slanted in the sense that they are not straight and they are not equal. In this case, the line of support is steeper than the resistance. This pattern generally signifies that a coin's price will eventually decline more permanently, which is demonstrated when it breaks through the support level. As you can see, it is bearish. So once you see a wedge, be expecting that the support will most likely be broken. And once it's broken, you enter once the price closes below that line. Once price closes below this line, you enter the trade and you ride your profits. So at this point, you are shorting the market, you are not longing it. You are shorting the market here, then the bearish movement will continue and you take your profit. So that is just basically how it works for the rising wedge. This is another example of the rising wedge, as you can see. It is not straight like channel. So once it comes down and breaks the support. And the next one is the falling wedge. The falling wedge is the bullish one. The falling wedge is bullish, while the rising wedge is bearish. Take note of the difference. So this is the falling wedge. Is the opposite of the rising wedge. Support is below, then resistance. You wait for it to break the resistance. Once it breaks the resistance, you enter the market and you ride your profit. You can also wait for reversal if it has passed your entry. Most times, it tends to retest the line. It tends to retest the line, then head in the other direction. So a falling wedge occurs between two downwardly sloping levels. In this case, the line of resistance is steeper than the support, as you can see here. It is steeper than the support. A falling wedge is usually indicative that a coin's price will rise and break through the resistance. Once you see something like this, you know that you are most likely going to change. It is a reversal pattern. That this trend, this downward trend, is most likely to change, and the resistance might be broken. So both rising and falling wedges are a reversal pattern. The rising wedges is bearish, while the falling wedge is bullish. Kindly take note. Then the next one is the pennant or flag. I need to drink water, just a minute. Sorry about that. So this is a pennant. We call it pennant. It's similar to a triangle. It looks like a triangle, but it is not closed. So pennant patterns or flags are created after an asset experiences a period of upward movement followed by a consolidation. As you can see, it was already going on an uptrend. Then it started consolidating in between. You see a lot of candles around this place. You see a lot of candles here. So generally, there will be a significant increase during the early stages. Like it will be moving very fast. As you can see, it was moving very high. Like the movements are obvious, but when it gets here, the movements become slow and the candles become smaller. The candles will become smaller. You'll be seeing small movements, small movements. Here you get. So there will be significant increase during these early stages, but when it enters a series of smaller upward and downward, as you can see, the movements become very small, very small, very small. Then it will break the resistance and move to the upside. So pennants can either be bullish or bearish, depending on which side, which trend you find it. And it can also represent a crash, depending on which side, which trend you find it. And it can also represent a continuation. So it is bilateral, technically. But most of the time, a pennant is usually bullish. It is usually bullish most of the time. So it can be bilateral, but most times it is bullish. So they either show continuations or reversal. It will come sideways, so the support can be broken and the resistance can be broken. The most important thing is that once you identify the chart patterns on time, be careful and look out for which side it is breaking out to, whether it is the downside or to the upside. Then you place your entry. So while a pennant may seem similar to a wedge pattern or a triangle, it's very similar. It is important to note that wedges are narrower than pennants. Wedges are more narrow than pennants or triangle, and also wedges differ from pennants because wedges are always ascending or descending, but a pennant is always horizontal. Kindly take note. As you can see, it is horizontal. It's almost like the same line. If you draw an horizontal line here and an horizontal line here, it is similar. It is very close, but it's different from a wedge. Let me show you the wedge again so you can understand what I'm saying. So as you can see, the wedge is going up. It is going up or down. It is direct, but a pennant is not like that. A pennant can be horizontal. It is neither up nor down, as you can see. So it will signify a break to the downside or to the upside, depending on whether it's the bull that has the power at that moment or the bears. So that is that for pennants. Then the next one is the triangles. We have the ascending triangles. So this is the ascending triangle. It's also similar, but when you look at it, you see that the trend is going up. The trend is going up. Ascending triangle is a bullish continuation pattern. You majorly see ascending triangles in a bullish trend, in an uptrend. That is when you see an ascending triangle forming. So ascending triangles can be drawn onto chart by placing a horizontal line along the swing eyes. Remember, higher eye, higher eye, higher eye, higher eye. So you place the trend line, then another one at the top. It will be horizontal and it will draw down a little bit. It does not have to be exactly like this. But once you see an ascending triangle, you will know that it's an ascending triangle because it will clearly be on an uptrend and there will be a very, very clear swing point. Like the swing point will be very clear. Then this will either be horizontal or a little bit slanty. So ascending triangles often have two identical peak eyes. Yes, the eyes are almost identical, like an horizontal line. It is almost horizontal. So this trend signifies the overall uptrend of the pattern. So while the horizontal line indicates the historic level of resistance for that particular asset. So what you have to do in this kind of pattern is to wait for a breakout also. Then you continue in the trend, or you wait for it to come back here. Then you enter the market. But most of the time, an ascending triangle is always bullish. Always, all the time, it's always bullish. Then the next one, which is the opposite of the ascending triangle, is the descending triangle. So as you can see, this is the descending triangle. What you'll be seeing is lower highs, lower highs. You only see descending triangles on a downtrend. Then you see an horizontal support. You know how a triangle looks like. So a triangle that is like this, then once there is a breakout, expect it to go down and retest that support line. So most times, most traders wait for the retest before entering the market to be very sure that we are now on a downtrend. But sometimes there can be a fake breakout around this place. As you can see, it came down but came back to retest it. Sometimes it might come down here, then break out to the upside and continue again. But most of the time, once it closes below the support line, it is going down. It is going down. So try to identify and understand the strategy behind every pattern you are seeing. So descending triangles generally shift lower and break through support because they indicate that the market is dominated by sellers. So meaning that there will be lower peaks and it is most unlikely not to reverse. So once it breaks out, once it is clearly a descending triangle, once it breaks out, it is going down. The next set of candles will definitely lead to a downtrend for a significant period of time, depending on what time frame you are analyzing. Then the last one is the symmetrical triangle. So this is similar to pendants also, but this one is it will be clearly a triangle. It will be clearly a triangle in the sense that you will see the shape clearly. It is going to form exactly like this. It is going to form clearly a triangle. You'll be seeing higher lows, higher lows, higher lows, lower high on the downtrend. So the symmetrical triangle pattern can either be bullish or bearish. It is bilateral. It can go either ways, depending on the market. In either case, it is normally a continuation pattern, which means that the market will usually continue in the same direction as the overall trend once the pattern is formed. So if you find this pattern in an uptrend, expect the price to break out to the upside. But if you find the symmetrical triangle on a downtrend, remember, before identifying chart patterns, you need to understand the trend that the market is going at that moment, whether we are on an uptrend or a downtrend or we are ranging. So if you find it on an uptrend, expect it to go up. But if you find it on the downtrend, expect it to break to the downside. But if you find it in a ranging market, just stay patient, do not do anything, and wait to see which direction it is going. So you wait for the breakout. If you break out to the top, enter at the close of that candle above the resistance line. And if it is here also, wait for it to close below this support line before entering the trade, and set your stop loss within the triangle. So if there is no, that is just the basic. The market will break out in either ways if it is consolidating. So like I said, just wait, be patient. You don't need to rush when you see it in the market. So in summary, all of these patterns that I have explained so far, they are very, very, very useful technical indicators which can help you to understand how or why a coin's price moved in a certain way and which way it might move in the future. This is because chart patterns are capable of highlighting areas of support and resistance. They even make the charts clearer to you. You see them clearly. So it can also help you as a trader to decide whether you should open a long or short position, or whether you should close out your open position in the event of a possible trend reversal. So these chart patterns will help you understand the market, when to enter the market, when to exit the market, when to stay off the market, and just watch and wait for what is most likely to happen. That is why you need to understand all these chart patterns perfectly, like very, very perfectly. You don't need to rush at all. So the assignment now is that identify all the 12 chart patterns I've explained so far. I think I explained, the wedges is 2, then the triangles, I think, is 11. I explained 11 chart patterns. So identify the 11 chart patterns on your chart and send to the group. I will open the group for as long as I can. So that is the assignment. Identify all the chart patterns on your chart, send a screenshot and post on the group chat. That will be all for now. So in the next class, we'll be talking about time frame analysis in details. We'll be talking about time frame analysis in details. And after that, we'll enter into retest, reversal. They will combine everything together, how to enter your trade, how to set stop loss and everything. So before the end of this month, we'll be done with the basic technical analysis class. Good night and God bless us all.
I only trade with TENTRADE. You should too. Check the description in this video for more info.
Here, these are some of the exclusive benefits you get from me when you sign up with TENTRADE through my link and get any of the instant live funded accounts or the Express Challenge accounts. Send me a DM for any enquiry. TENTRADE has the fastest withdrawal in the industry and they've been around since 2017, and they have trader friendly rules and they want their traders to succeed. They have the best customer service in the industry too, and they are giving a personal account manager once you sign up. A trial will convince you and you are in safe hands. Don't forget to click the Linktree link in the description for any enquiry.
Follow me for more educative contents like this.